All right, so we've got a pretty fascinating stack of stuff to dig into today.
We do, yeah.
And today we're zeroing in on kind of like the practical takeaways, right?
Okay.
So we're talking about business knowledge, personal finance, all that good stuff that can really help, move the needle for our listeners.
That's the goal.
Yeah, so, we've gone through a ton of stuff, YouTube video transcripts with some really bright folks in there, like entrepreneurs, people talking about the foundations of finance and economics. We even went through some personal wealth management strategies, right?
Absolutely. We tried to cover all the bases, even pulled in a financial education program guide, and some just like really fundamental texts on financial concepts.
Yeah, so, at the end of the day, our mission is to kind of extract those nuggets, those actionable insights that you can actually use to start and grow a business, manage your money, and just wrap your head around those core economic and financial principles that are going to help you become financially independent. So, where should we kick things off? What stood out to you as some of the most valuable stuff?
Well, one of the most interesting things I saw was actually a challenge to some of the most common advice that you hear about starting a business.
Oh, really? Okay. Yeah, I'm always interested in those kind of like shakeups of conventional wisdom.
Yeah, so, the classic advice is you start by identifying a gap in the market. Right.
Right, right. Like what needs aren't being met.
Exactly. But one of the speakers, Simon Squibb, from one of the YouTube transcripts, he argues that you should actually start with your passion.
Oh, interesting. So like what you're actually genuinely interested in doing.
Yeah, like what do you enjoy doing? What comes naturally to you? That kind of thing.
Okay, I see where he's going with this.
And he uses his own experience as an example. He started this successful agency called Fluid. And get this, there were already like 500 competitors in that market.
Wow, okay, so a pretty crowded space.
Right. So it wasn't like he found this brand new niche that no one was serving.
Yeah.
But what he had was this genuine passion for helping businesses and people grow. And this deep interest in marketing, that's what drove him.
I like that. That's kind of like, I don't know, liberating in a way, you know?
Yeah.
It takes the pressure off of having to come up with this completely novel idea right out of the gate.
Exactly. And it ties into another key idea that he emphasizes, aligning your values with your business. He calls this your mobile code.
Mobile code, okay.
Yeah, it's basically about making sure that what feels right for you personally is reflected in your work, the day-to-day of your business, the culture you build.
Right, yeah, that makes a ton of sense because if there's that fundamental mismatch between your core beliefs and how you're spending most of your time, you're going to run into some problems down the line, even if the business is doing well financially.
Absolutely. And speaking of finding the right people, another tricky part of starting a business is finding a co-founder.
Oh, yeah. Finding a good business partner, it can be like trying to find a needle in a haystack.
Squibb actually has some good advice on that too. He says, the first step is to be super clear about the traits and skills you're looking for in a partner.
Okay, so like make a list, really nail down what you need.
Exactly. And then once you have that picture in mind, you got to actively post your need.
Post, you mean like on social media?
Well, not just that. It's more about intentionally telling your network what you're looking for. Asking people directly, being open to possibilities that come up in your everyday conversations.
Gotcha. So it's like putting it out into the universe, but in a more targeted way.
Exactly. And of course, once you find that co-founder, you need to sort out equity and all that, which we can talk about later.
Yeah, definitely important stuff. So we've got starting with passion, aligning your values, and actively seeking out the right co-founder. What else did you find in this treasure trove of entrepreneurial wisdom?
Well, there's a really great point about selling.
Okay, yeah, that's a big one.
So Squibb emphasizes that it's not just about presenting the features of your product, it's about selling the sizzle, not the steak.
I like that, the sizzle. So it's about the experience, the benefits, the emotional connection.
Exactly. He uses Apple under Steve Jobs as an example. Their product launches weren't just dry technical presentations. They were events designed to create excitement, to make people really desire the product.
Yeah, focusing on how it's going to improve their lives, not just the specs, right?
Right. And this ties into the importance of building a brand, and especially a personal brand in today's world.
Yeah, he's a big believer in personal branding, right?
He is. He says it's absolutely essential these days, both in terms of your public perception and within your specific industry.
Makes sense. People connect with people. They want to see the faces behind the brand.
Exactly. And moving on from those early stages, your sources also talk about hiring, scaling a business, and the surprisingly accessible nature of going global, which can be a great way to diversify your income and reduce your reliance on one market.
Yeah, going global, that's something a lot of entrepreneurs might not even consider at first.
Right. But it can be a really smart move. And he also mentions finding mentors, which is a resource that many people don't fully utilize.
Yeah, mentorship can be invaluable.
And crucially, he emphasizes the importance of avoiding those big, fatal mistakes that can kill a business while still being open to new opportunities, making your own luck.
Making your own luck. I like that it's not just about random chance, right?
Exactly. It's about being proactive, putting yourself in situations where good things can happen, and being ready to seize those opportunities when they come along.
Absolutely. So we talked about equity a bit earlier and the possibility of selling your business down the line. Now let's dive into funding, because that's obviously a huge part of getting any business off the ground.
For sure, and Squibb breaks down a few different avenues, starting with personal savings and bootstrapping, which is essentially using your own money to fund your business.
Right, putting your money where your mouth is shows a lot of commitment.
Exactly, and it can be a great way to maintain control in those early stages. Then there's funding from family and friends, which can be a good option because of the existing trust.
Yeah, but that can also be tricky, right?
Oh, definitely. He emphasizes that you need to be super transparent with loved ones about the risks and the fact that they could lose their investment.
Yeah, you don't want to jeopardize those relationships over money.
Absolutely. And he also suggests looking beyond your immediate family and friends, maybe to friends of friends who have more financial resources and might be a little more objective.
Right, a little bit of distance can sometimes help in those conversations.
Definitely. And then there's this really clever idea he talks about, leveraging your own clients as investors.
Oh, interesting. Tell me more about that.
So he describes it as a hack because it's not the typical route, but the idea is that if your clients really value your services, they might be willing to invest in your growth, which benefits them in the long run too.
Okay, so it's like a win-win. Their investment helps you grow, and they continue to benefit from your services.
Exactly. But he does mention that you need to be careful about potential conflicts of interest. Like if a bank invests in your business, it might create issues if you're working with other financial institutions.
Right. Yeah. You got to think about the bigger picture. So, what about brand sponsorships? They seem to be pretty popular these days.
Squibb emphasizes that you want genuine alignment with the brands you partner with, where their mission resonates with yours. He gives examples like GoDaddy and Thai Banking, where the people behind those brands really care about supporting entrepreneurs.
So, it's not just a transactional thing, it's a genuine connection.
Exactly. And here's a really interesting tip. He suggests working with media buying companies and ad agencies to secure sponsorships.
Oh, that's an angle you don't hear about that often.
Right, so instead of going directly to the brand, which might be inundated with requests, you pitch your offering to the media buyers who are already managing budgets for brand placements.
Gotcha. So, you're tapping into existing relationships and financial structures.
Exactly. And he also mentions the power of organically using and showcasing brands you genuinely believe in, like he talks about using a Ring doorbell and wearing a Whoop tracker, which led to actual partnerships with those companies because they noticed his authentic endorsement.
So, real enthusiasm and organic integration can actually attract brand collaborations. I like that. So, we've covered a lot about getting a business off the ground. Now let's talk about what it takes to actually build a successful, sustainable business in the long run.
Well, Squibb is a big advocate for purpose-driven businesses, having a clear reason for existing beyond just making money.
Yeah, I think that resonates with a lot of people these days, especially younger generations.
Absolutely. And he says that to really grow, you need to bring in people who are valuable, who feel ownership in that purpose.
Yeah.
And you need to take care of your team and your customers. It's a long-term game.
A people-centric approach. I like it. It seems like a more sustainable model, especially in today's world.
Definitely. And he also emphasizes the importance of taking risks, testing your ideas. He talks about building minimum viable products, or MVPs, as a way to quickly get feedback and iterate.
The fail fast, learn faster approach.
Exactly. And he warns against becoming complacent. He uses Blockbuster and Kodak as examples of companies that didn't adapt to changing times. Kodak actually invented the digital camera, but was too hesitant to disrupt their film business.
Wow, that's a classic example of the innovator's dilemma. Sometimes your past successes can hold you back if you're not careful.
Exactly. And finally, he talks about the shift from being a generalist to a specialist as your business grows, building systems that allow for specialized roles.
So, like, as you scale, you need people who are really good at specific things.
Right. And he even says that founders themselves might need to specialize or even step aside if it's in the best interest of the company, which is a pretty mature realization for some founders.
Yeah, it's about recognizing that your own skills might not always be what the company needs to thrive. So let's switch gears a bit and talk about the entrepreneurial mindset, those underlying ways of thinking that really contribute to success.
Yeah, so one of the texts we looked at by John Mullins, he outlines 6 unconventional mindsets that really challenge the traditional rules of business.
Okay, I'm all ears. Let's hear about these rule-breaking approaches.
So the first one is the yes, we can attitude. And he illustrates this with the story of Arnold Correa, a Brazilian entrepreneur who built his business, Atmo Digital, by constantly saying yes to new client requests, even if they were outside his initial area of expertise.
Wow, so like embracing the unknown and learning on the fly.
Exactly, and that willingness to take on new challenges led to some unexpected growth for his business. The second mindset he talks about is problem first, product second.
Okay, so like don't just focus on the product itself, focus on what problem it's solving.
Right. He contrasts this with big companies that often make incremental changes to existing products, like tweaking the formula for Tide detergent or launching new Coke, which obviously didn't go so well.
Yeah, those are good examples. So it's about starting with a real problem that people are facing and then developing the product as the solution.
Exactly. He uses the story of Nike as a perfect example. Phil Knight and Bill Bowerman, they were focused on solving the specific needs of long-distance runners. They created lighter, more efficient shoes, which was a big departure from the heavier running shoes that were common at the time.
Yeah, and that laser focus on a specific problem and customer need led to, well, Nike becoming Nike.
Exactly. The third mindset is about reframing the idea of funding. Instead of seeing it as the ultimate goal, it's seen as the fuel that allows you to pursue a bigger mission.
This sounds a lot like Elon Musk and Tesla, right?
Absolutely. Their mission was and still is sustainable transportation. They released products strategically, starting with the expensive Roadster, not just to make money, but to fund the development of more affordable electric cars.
Yeah, it was about achieving that larger vision, not just about maximizing profits in the short term.
Exactly. And they targeted those early adopters, the people who were passionate about the environment, who had the means to buy that first expensive car.
And those initial sales funded the next stage of their plan. It's a pretty smart approach. So now let's dive into some of the fundamentals, the core knowledge of finance and economics that underpins both business and personal finance.
Okay, sounds good.
Now, this stuff can get a little complex, but I think your sources did a good job of breaking it down into digestible pieces.
They did, yeah. So we start with 3 key concepts: time value of money, compound interest, and net present value, or NPV.
All right, let's tackle those one by one.
So time value of money basically means that money today is worth more than the same amount of money in the future.
Yeah, that makes sense. Like a dollar I have now can be invested and potentially grow.
Exactly. And then there's inflation, which erodes the purchasing power of money over time. So the dollar you have today will buy less in the future.
Right, okay, so that's time value of money. What about compound interest?
Compound interest is all about earning interest on your interest. So your money grows exponentially over time. The classic example is investing $1 at a 10% annual interest rate. After 20 years, that dollar would grow to over $6 just from the power of compounding.
Wow, okay, so even small amounts can really add up over time. That's why it's so important to start investing early.
Exactly. And then there's net present value, or NPV, which is a way to evaluate the profitability of an investment by comparing the present value of its future cash flows to the initial investment cost.
Okay, so it's like, is this future stream of income worth the upfront investment I'm making today?
Right, and it takes into account things like the time value of money and the risk associated with the investment. If the NPV is positive, it means the investment is likely to be profitable.
Gotcha, so that's a really important tool for making investment decisions. Now let's talk about capital markets, which is where we encounter things like stocks and bonds.
Right, so stocks represent ownership in a company. When you buy a stock, you become a shareholder, you have the potential to benefit from the company's growth, and you might receive dividends, which are a portion of the company's profits.
Okay, so you're basically getting on the company's success.
Exactly. And bonds are different. They represent debt. So when you buy a bond, you're lending money to a company or government.
Right, and in return, you get regular interest payments.
Exactly. And at the end of the bond's term, you get your principal back. Bonds are generally considered less risky than stocks, but they also don't have the same potential for growth.
So it's a trade-off between risk and potential reward. You often see this reflected in the prices. Stocks tend to fluctuate a lot more than bonds.
Exactly. And when it comes to valuing a stock, it's all about the company's future cash flows and the risk associated with those flows. There are complex methods like discounted cash flow analysis, but there are also simpler metrics like valuation ratios that can give you a quick snapshot of a company's value compared to others in the same industry.
Yeah, those ratios can be really helpful for getting a quick comparison. Now let's talk about business strategy, which is a pretty broad topic. What did your sources highlight as some key concepts?
Well, at its core, business strategy is about how a company plans to achieve its long-term goals. And it often starts with a clear mission statement, something that concisely describes the company's purpose, like Microsoft's mission to empower every person and every organization on the planet to achieve more.
Right, a statement that captures the essence of what the company is all about.
Exactly. And then there's SWOT analysis, which is a way to evaluate a company's strengths, weaknesses, opportunities, and threats.
So it's like a 360-degree view of the company and its environment.
Exactly. And there are tools like the BCG matrix, which helps companies categorize their products or business units based on market share and growth potential. Are they stars, cash cows, question marks, or dogs, that kind of thing.
Yeah, different categories with different strategic implications.
Right. And then there's Porter's generic strategies, which are about how to achieve a competitive advantage, either through cost leadership, differentiation, or focusing on a specific niche.
So different paths to success depending on the company and the industry.
Exactly. And then we move into financial statements, which can be a bit daunting, but they're essential for understanding a company's performance.
Yeah, they can seem intimidating, but they're basically just telling a story about the company's finances.
Right. So the three main ones are the statement of profit or loss, also known as the income statement, the statement of financial position or balance sheet, and the statement of cash flows.
Okay, so the income statement tells us about the company's profitability over a period of time, and the balance sheet is like a snapshot of what the company owns and owes at a specific moment.
Exactly. And there are various ratios you can use to analyze these statements, things like profitability ratios, liquidity ratios, and solvency ratios. These help you assess the company's financial health and compare it to others.
Yeah, those ratios can reveal a lot about how the company is doing. There's also horizontal analysis, which is about looking at changes over time, and common size analysis, which helps you compare different companies by expressing their financial data as percentages.
Right. So you can see how a company's performance is trending and how it stacks up against its peers. Now let's talk about capital budgeting, which is all about those big long-term investment decisions that companies make.
Yeah, like buying new equipment, expanding facilities, that kind of thing.
Exactly. And there are different methods for evaluating these projects, like payback period, which tells you how long it'll take to recoup your investment, net present value, which we talked about earlier, and internal rate of return, or IRR, which is the discount rate that makes the MPV of a project equal to zero.
So a bunch of tools for making those big investment decisions. Now let's zoom out and talk about the broader economic environment that businesses operate in.
Okay, so that's where we get into the business cycle and macroeconomics.
Right, the ups and downs of the economy.
Exactly. So the business cycle typically has four phases. A trough, which is the low point, an expansion, where the economy is growing, a peak, which is the high point, and then a contraction, which can sometimes turn into a recession.
And these cycles are influenced by all sorts of things, right?
All right, things like consumer confidence, interest rates, government policies, it's all interconnected.
Yeah, a lot of moving parts. So what are some of the key things that economists look at when they're trying to understand the economy?
Well, there's GDP, which stands for Gross Domestic Product. It measures the total value of goods and services produced in a country.
Okay, so it's like a measure of the overall size and health of the economy.
Exactly. And then there's unemployment, which is a percentage of the workforce that's actively looking for work but can't find it.
Right. A big concern for policymakers.
Definitely. And there are different types of unemployment. There's cyclical unemployment, which is tied to the business cycle. Then there's structural unemployment, which happens when people's skills become obsolete, like typewriter repairmen when computers took over.
Yeah, that makes sense. Technology can definitely disrupt the job market.
And then there's frictional unemployment, which
Yeah.
is just the natural churn of people moving between jobs.
Okay, so those are the different flavors of unemployment. What about inflation?
Inflation is the rate at which prices are rising, so your money buys less over time.
Right. That's why it's important to invest your money so it can keep pace with inflation.
Exactly. And then there are interest rates, which are the cost of borrowing money. They're influenced by central banks through monetary policy, which can be used to stimulate or cool down the economy.
Okay, so the Fed can raise or lower interest rates to try and control inflation and encourage growth.
Exactly. And there's also fiscal policy, which is about government spending and taxation that can also have a big impact on the economy.
Yeah, a lot of levers that policymakers can pull. Now let's talk about something that's becoming increasingly important in the business world, ESG, which stands for environmental, social, and governance factors.
Right. ESG is all about measuring a company's impact beyond just its financial performance.
So it's about sustainability, social responsibility, and ethical behavior.
Exactly. So environmental factors include things like a company's carbon footprint and its impact on the environment. Social factors cover things like labor practices, human rights, and community engagement. And governance is about the company's leadership, its transparency, and its ethical practices.
So it's a much broader view of what it means to be a successful company.
Absolutely. And there's growing evidence that companies with strong ESG practices actually perform better financially in the long run. It's not just about doing good, it's also good for business.
And investors are paying more attention to this too, right?
Definitely, ESG is becoming a key factor in investment decisions. Now, finally, let's talk about portfolio diversification and risk management, which are essential for both businesses and individuals.
Right, the old don't put all your eggs in one basket idea.
Exactly. Diversification is about spreading your investments across different asset classes, industries, and geographic regions to reduce your overall risk.
So if one investment does poorly, it doesn't wipe out your entire portfolio.
Right. And there are vehicles like index mutual funds and exchange-traded funds or ETFs that make it easy to diversify your investments.
Yeah, they're basically baskets of stocks that track a particular index, so you're getting exposure to a lot of different companies with one investment.
Exactly. And this is considered passive investing, as opposed to active investing, where you're trying to beat the market by picking individual stocks.
Okay, so passive investing is generally considered lower risk and lower effort. Now let's shift gears and talk about personal finance, and specifically what some call the 1% mindset.
Okay, yeah, so this is about going beyond just earning a high salary. It's about achieving true financial success.
And that starts with a different approach to managing your money, right?
Absolutely. The 1% mindset is all about paying yourself first. So instead of spending your income and then saving whatever's left over, you prioritize saving and investing right off the bat.
So it's like a mindset shift. Instead of treating saving as an afterthought, it becomes a non-negotiable priority.
Exactly. There are rules like the 7-5-1-5-10 rule, where you allocate percentages of your income to needs, wants, and savings, or the more aggressive 50-30-20 rule.
Okay, so different frameworks for prioritizing saving and investing.
Right, and financial education is also a huge part of this mindset, constantly learning about money, whether it's through books, videos, courses, or even just learning from your own mistakes.
Yeah, it's an ongoing process, always striving to improve your financial literacy, and the power of compound interest is a key concept here, right?
Absolutely. The earlier you start investing, the more time your money has to grow exponentially. There's this example of investing just $4 a day at a 10% annual return. After 45 years, that would grow to over $1 million.
Wow, that really highlights the power of time and consistency.
It does. And if you increase those contributions over time, it becomes even more impactful, reaching over $2 million in the same scenario. And if you reinvest any cash flow from those investments, it can grow to over $4 million in the long run.
So the key takeaways are start early, be consistent, and reinvest your earnings.
Exactly. And it's also important to understand the relationship between risk and reward. There's a spectrum of investments, from low risk, low return options like savings accounts to high risk, high return options like starting your own business.
So it's about finding the right balance for your risk tolerance and your financial goals.
Right. And financial education can actually help you reduce your perceived risk, because the more you know, the better equipped you are to make informed decisions.
And the 1% mindset encourages you to view mistakes as learning opportunities. So don't be afraid to make mistakes as long as you learn from them.
Exactly. Now let's talk about investing for cash flow, which is a different approach than just focusing on appreciation.
Okay, so this is about generating income from your investments, not just hoping that they'll go up in value.
Right. It's about creating a stream of passive income that can cover your expenses and give you financial freedom.
And this often involves starting with a specific cash flow goal and then working backward to figure out what investments you need to make to achieve that goal.
Exactly. And you also need to consider inflation, because the purchasing power of your cash flow will erode over time if it doesn't keep pace with rising prices.
Right, so you might need to adjust your investments over time to maintain your desired cash flow. And real estate is often mentioned as a great option for cash flow investing, isn't it?
It is, yeah. Real estate is a tangible asset that can generate consistent rental income. The basic idea is you buy a property and then rent it out to tenants.
And the goal is to maximize your cash flow after all expenses are paid.
Right. There's a metric called cash-on-cash return, which is calculated by dividing the property's net operating income, or NOI,
Hmm.
by the total amount of cash you invested.
So it tells you what percentage return you're getting on your investment.
Exactly. And it's important to remember that higher potential returns usually come with higher risks, like tenant issues or problems with the property itself.
Yeah, real estate investing is not without its challenges.
Definitely. But there are also strategies for increasing your cash flow, like making renovations to justify higher rents or targeting distressed properties that you can buy at a discount.
So real estate can be a great way to generate passive income, but it also requires careful planning and management, even if you hire a property manager.
Absolutely. Now, another key element for financial success is what's often called the mental game of money.
So like your mindset, your beliefs about money.
Exactly. Your subconscious beliefs about wealth can have a huge impact on your financial behaviors and your results.
Yeah, it's like a self-fulfilling prophecy. If you believe you can't be wealthy, you probably won't be.
Right. So it's important to cultivate a positive money mindset, to believe that you can achieve your financial goals. And it's also about balancing the emotional side of money with the practical strategies.
So finding that sweet spot between your feelings and your actions.
Exactly. And staying informed about financial markets and trends through reliable sources can help you make better decisions.
Right. Knowledge is power, especially when it comes to money. And the 1% mindset also encourages you to think bigger about your financial possibilities.
Absolutely. There's so much wealth in the world, and it's important to realize that you can achieve a lot more than you might think.
It's about expanding your horizons and setting ambitious goals.
Exactly. Now, when it comes to saving cash, it's important to be strategic. Having an emergency fund is crucial. It should cover 3 to 12 months of living expenses, depending on your individual circumstances.
So that's your safety net, your financial cushion in case of unexpected events.
Exactly. And it can also create opportunities. Like if the market crashes, you have cash on hand to buy assets at a discount.
Great. But you also need to be aware of inflation because if your cash is just sitting in a savings account, it's losing value over time.
Exactly. So it's important to convert that cash into income-generating assets. That's how you build true wealth.
Right. So stocks, real estate, businesses, those are the things that are going to appreciate in value and generate income.
Exactly. And there are certain productivity habits that wealthy people tend to adopt that can help you free up time and resources for building wealth.
Oh, interesting. Like what?
Well, there's the Netflix effect, which is basically about cutting back on time-wasting activities like binge-watching TV, so you have more time for productive pursuits.
Yeah, it's about valuing your time and making sure you're spending it on things that are actually moving you forward.
Exactly. And then there's the eat the frog principle, which is about tackling your most difficult task first thing in the morning.
Okay, so getting that big thing out of the way so you can focus on the rest of your day.
Right. And delegation is another key habit, learning to outsource tasks that you're not good at or that don't generate a high return on your time.
So you can focus on your strength and the things that really matter.
Exactly. And then there's this idea of building an entity, recognizing that businesses create value through the collective efforts of a team, like Tesla or Amazon.
So it's not just about individual effort, it's about building something bigger than yourself.
Right. Now, it's also important to differentiate between financial freedom and extreme wealth.
Okay, so what's the difference?
Financial freedom is about having enough passive income to cover your living expenses so you don't have to work for a paycheck.
So you can do what you want with your time.
Exactly. Whereas extreme wealth is a whole other level, private jets, multiple mansions, that kind of thing.
Right, a different lifestyle altogether. So how do you create a financial system that sets you up for success?
One simple but effective strategy is to have 3 separate bank accounts. One for spending, one for investing, and one for saving.
Okay, so you're compartmentalizing your money based on its purpose.
Exactly. This helps you automate your savings and investments because the money is already allocated before you even have a chance to spend it.
So it takes discipline out of the equation.
Right. Now, when it comes to investing in the stock market, a passive approach using ETFs is a great option for beginners.
Yeah, ETFs are those baskets of stocks that track a specific index, so you get instant diversification.
Exactly. And they're ETFs for all sorts of things like the total stock market, the tech sector, emerging markets, dividend-paying stocks, you name it.
So you can tailor your investments to your specific goals and risk tolerance.
Right. And the keys to success with stock market investing are consistency, making regular contributions over time, and being mindful of fees, because even small fees can eat into your returns over the long run.
Yeah, those fees can really add up. So it's important to choose low-cost ETFs and automate your investment so you don't have to think about it.
Exactly. And then there's real estate, which is another great avenue for building long-term wealth.
Yeah, real estate is a tangible asset that can appreciate in value and generate cash flow, but it's also a lot more hands-on than stock investing.
It is, yeah. You need to be much more involved in managing your properties, even if you hire a property manager.
Right, and location is absolutely crucial in real estate. You can change almost anything about a property except its location.
Exactly. So it's important to do your research and choose areas that are growing, with good schools, low crime, and amenities that people want.
And it's also a good idea to build a strong real estate team, people you can trust to help you find good deals, manage your properties, and handle any legal issues.
Definitely. Having the right team in place can make all the difference in real estate. And it's important to remember that even with relatively small but consistent investments, becoming a millionaire in the stock market is very achievable.
So, time and consistency are your biggest allies. It's not about getting rich quick, it's about playing the long game.
Exactly. Now, once you've accumulated some wealth, it's important to protect it. So having a good attorney, a good accountant, and good insurance are all essential.
Yeah, you want to make sure you're covered in case anything unexpected happens.